Many of the biggest moments in financial history have shared one thing in common: widespread confidence that a new era had arrived. Whether it was the rise of the internet in the late 1990s, Japan's economic boom in the 1980s, or other periods of extraordinary market optimism, investors believed technology and innovation had fundamentally changed the rules. Today, artificial intelligence has become the latest force driving that conversation. The U.S. stock market continues to reach remarkable milestones, fueled largely by excitement surrounding AI and the companies leading its development. Supporters argue that artificial intelligence represents one of the most important technological breakthroughs of the modern era, one that could reshape industries, boost productivity, and generate enormous corporate profits for years to come. But not everyone is convinced that today's soaring valuations are supported by economic reality. A growing number of economists, portfolio managers, and veteran investors have begun asking whether expectations have moved too far ahead of fundamentals. Their concern isn't necessarily about AI itself. Few dispute its long-term potential. Instead, the debate centers on whether investors are paying prices that already assume years or even decades of future success. Some of Wall Street's most experienced voices have also urged caution. They point out that revolutionary technologies often create tremendous opportunities, but history shows they can also inspire periods of excessive speculation. Markets have repeatedly demonstrated that even transformative innovations can become temporarily overvalued when enthusiasm outpaces financial performance. So, where does today's market really stand? Are current stock prices reflecting genuine economic progress, or has investor excitement pushed valuations into historically unusual territory? In this video from Geoeconomics, we'll examine the data, compare today's market with previous investment cycles, and explore what the evidence may be telling us about the opportunities and the risks that lie ahead. Financial markets have always been driven by a combination of economic fundamentals and investor psychology. While earnings, innovation, and productivity shape long-term value, confidence and expectations often determine how quickly prices move in the short run. That's why many analysts are comparing today's AI-driven rally with previous periods of extraordinary market enthusiasm. Not because they believe history repeats exactly, but because market behavior often follows familiar patterns. One of the most frequently cited comparisons is the dot-com boom of the late 1990s. During that period, investors recognized the enormous potential of the internet, and they were ultimately correct. The internet transformed commerce, communication, and nearly every major industry. However, many companies were priced as though future success was already guaranteed. When expectations became disconnected from financial reality, the market experienced a painful correction in the early 2000s. While many internet businesses disappeared, the technology itself continued to reshape the global economy. Analysts also point to Japan's asset bubble during the late 1980s. At the time, Japanese real estate and stock prices climbed to extraordinary levels as optimism about the country's economic future accelerated. Investors believed rapid growth would continue indefinitely. Instead, valuations eventually became unsustainable, leading to one of the longest periods of economic stagnation in modern history. Even further back, market historians often reference the years leading up to the 1929 stock market crash. That era was also characterized by widespread optimism, expanding credit, and growing confidence that prosperity would continue without interruption. Although today's financial system is very different, the episode serves as a reminder that excessive expectations can sometimes create vulnerabilities beneath an otherwise strong economy. Current market conditions are naturally prompting comparisons with those earlier periods because leadership has become increasingly concentrated. A relatively small group of companies has generated a large share of recent market gains, particularly businesses closely associated with artificial intelligence, cloud computing, and advanced semiconductor technology. Similar concentration has appeared during previous investment booms, although each cycle has been driven by different industries and economic conditions. At the same time, it's important to recognize that comparisons should be made carefully. Artificial intelligence is already producing meaningful commercial applications across healthcare, finance, manufacturing, software, and countless other sectors. Unlike many speculative trends of the past, AI is supported by genuine technological progress. The question, therefore, is not whether AI has value, but whether current stock prices accurately reflect that value. Understanding this distinction is essential. History does not guarantee that today's market will follow the same path as previous bubbles, but it does remind investors that revolutionary technologies and elevated valuations have often appeared together. The challenge is determining where legitimate innovation ends and excessive optimism begins. Whenever investors debate whether the stock market has become overheated, one question usually comes first. How expensive are stocks relative to their underlying businesses? Answering that question isn't as simple as looking at a single chart. Professional investors rely on several valuation metrics, each designed to measure the market from a different perspective. While no indicator can predict exactly when markets will rise or fall, together they help paint a broader picture of investor sentiment. One of the most widely used measures is the price-to-earnings ratio, commonly known as the PAE ratio. This compares a company's stock price with the profits it has generated over the previous 12 months. A higher PE ratio generally means investors are willing to pay more today for every dollar of earnings because they expect stronger growth in the future. During periods of optimism, these ratios often expand as investors become increasingly confident about long-term prospects. Another important measure is the forward PE ratio. Instead of looking backward at past earnings, it estimates what companies are expected to earn over the coming year. This metric is particularly useful for fast-growing industries because investors often price companies based on future expectations rather than current financial performance. However, it also introduces uncertainty. If those growth forecasts prove too optimistic, stock prices can adjust quickly when expectations are revised. Market analysts also examine broader indicators that evaluate the stock market as a whole rather than individual companies. One of the best-known examples is the relationship between total stock market capitalization and gross domestic product, often referred to as the Buffett indicator. The idea behind this measure is straightforward. If the total value of publicly traded companies grows much faster than the overall economy that supports them, valuations may eventually become difficult to justify. Supporters of this indicator argue that it provides a useful long-term perspective because corporate profits ultimately depend on economic activity. Critics, however, note that today's economy is far more global than it was decades ago. Many of America's largest corporations generate significant revenue overseas, making direct comparisons with domestic GDP less straightforward than they once were. Rather than relying on a single metric, many research firms combine several valuation measures into composite indexes. These may include trailing and forward earnings multiples, price-to-sales ratios, market capitalization relative to GDP, and other long-term indicators. When multiple measures point in the same direction, analysts often gain greater confidence that valuations deserve closer attention. Recent market data has fueled exactly this discussion. Across several commonly used valuation models, U.S. equities appear elevated relative to many historical periods. That observation does not automatically imply that a market correction is imminent. High valuations can persist for months or even years, particularly when investors expect strong earnings growth, technological innovation, or favorable economic conditions. The more important takeaway is that valuation reflects expectations as much as current reality. Investors are increasingly pricing companies based on what they believe artificial intelligence could achieve over the next decade, not simply on today's earnings reports. If those expectations are eventually realized, today's prices may appear justified in hindsight. But if growth falls short of those ambitious forecasts, markets may need to adjust to a different reality. For that reason, understanding valuations is less about predicting the next market move and more about recognizing the balance between opportunity and risk. As optimism rises, so do expectations. And history has shown that managing expectations is often just as important as measuring earnings. One of the defining characteristics of today's stock market is not simply that prices have risen, it's how those gains have been distributed. While the broader market has posted impressive returns, a significant portion of that performance has been driven by a relatively small group of companies. This growing concentration has become one of the most closely watched trends among professional investors. Over the past several years, artificial intelligence has emerged as the dominant investment theme. Companies involved in AI software, advanced semiconductor manufacturing, cloud computing, and data infrastructure have attracted enormous amounts of capital. Investors increasingly view these businesses as the foundation of the next generation of technological innovation, leading to rapid increases in both their market values and their influence over major stock indexes. This has created a situation where the performance of the overall market depends more heavily on fewer companies than in many previous periods. Major indexes, such as the S&P 500, are weighted by market capitalization, meaning the largest companies naturally carry the greatest influence. As these firms continue to grow, their movements have an increasingly outsized impact on the direction of the entire index. The result is that market headlines can sometimes paint a misleading picture. An index may reach a new all-time high even while many individual stocks are experiencing far more modest gains, or in some cases, declining altogether. Beneath the surface, market leadership has become increasingly concentrated among a handful of technology giants that dominate investor attention. Much of this leadership revolves around businesses connected to artificial intelligence. Companies designing advanced chips, operating cloud infrastructure, developing AI models, or supplying the computing power needed for machine learning have become central to investor portfolios. Their products are essential for expanding AI capabilities, making them some of the primary beneficiaries of the current investment cycle. There are understandable reasons for this enthusiasm. Artificial intelligence has already demonstrated the potential to improve productivity, automate complex tasks, accelerate scientific research, and create entirely new categories of software and services. If these technologies continue to mature, many of today's leading companies could generate substantial long-term earnings growth. However, concentration also introduces additional risk. When a large share of market performance depends on a small number of firms, any disappointment, whether from earnings results, regulatory changes, slower AI adoption, increased competition, or broader economic weakness, can affect the entire market more than investors might expect. Diversification within an index becomes less effective when a handful of companies account for such a significant percentage of total value. This dynamic has appeared in previous market cycles as well. During earlier periods of rapid technological change, investors often concentrated their capital in the companies viewed as future winners. Some of those businesses eventually justified their valuations and became dominant global enterprises. Others struggled to meet the extraordinary expectations that had already been reflected in their stock prices. That distinction remains critical today. The long-term success of artificial intelligence does not automatically guarantee that every company associated with the technology will deliver exceptional investment returns. A revolutionary industry can thrive while individual stocks experience significant volatility if expectations become too optimistic. For investors, the key question is no longer whether AI will shape the future. It almost certainly will. The more important question is whether today's market prices already reflect much of that future success. As valuations rise and market leadership becomes increasingly concentrated, understanding that difference becomes essential for evaluating both opportunity and risk.